This has been the worst start to a year for stocks in more than half a century. A record-setting run fueled by cheap money has ended, and Wall Street is having a hard time adjusting to a new reality. With the Federal Reserve aggressively hiking interest rates to fight high inflation, the economic landscape has changed dramatically. At the halfway point of the year, the tech-heavy Nasdaq has fallen by 30% and the broad-based S&P 500 is down by over 20%. Both indexes are in bear market territory, and the Dow Jones Industrial Average is in a correction. Year-to-date, it is down over 15%. When interest rates go up, it changes all the math, says Charles Bobrinskoy, Vice Chairman of Ariel Investments. It changes the math of buying a car, buying a house, buying a bond, and it changes the value of particularly tech stocks, whose earnings are far off in the future. And that means that all that whipsawing on Wall Street in the last few months, including the massive single-day swings of more than one. They're worried the Fed may tip the U.S. economy into a recession. While that volatility has been driven mainly by rising interest rates and inflation, it has been compounded by numerous geopolitical risks. COVID-19 continues to wreak havoc in the lockdowns in China, global supply chains remain clogged and Russia's invasion of Ukraine continues. Historically, when interest rates rise and borrowing costs go up, investors pulled out money from the riskier parts of the economy. High-growth companies and tech stocks are the first to see their stocks fall. This time is no different. The S&P 500's worst stock performer to date is Netflix, which is down 70%. It's an incredible reversal for a company that saw its share price skyrocket during the pandemic, when the streaming service became a lifeline for the locked down. The second worst performer is Etsy, the online marketplace for art and craft from artisans, which is down almost 65%. Really, the only bright spot in stocks has been energy. Russia's invasion of Ukraine drove oil and natural gas prices higher, and gasoline and diesel prices have set new records. That rise in commodities prices has benefited global energy giants. Many of them raked in record profits. So far, the best performer on the S&P 500 this year has been Occidental Petroleum, which has almost doubled in price. Valero Energy returned around 40% and Exxon Mobil, Hess, and Halliburton are also winners. What is perhaps the most startling to Wall Street is how quickly everything changed. The first signal came on January 5th, when a readout of a Fed meeting that took place at the end of last year was released. Those minutes showed how Fed members saw rising inflation as a major risk to the economy and they would have to start raising rates sooner than expected. The words were dry, as they often are, but the summary signaled a dramatic negative shift in the Fed's stance. The reaction in the markets was swift.